A very good afternoon, everyone, and thank you so much for joining us today. As you're aware, the agenda of this call is to discuss the Excess Business Cycle Fund, the NFO, which is going ongoing right now, and also to address the queries which we have received from you. As the name suggests, Excess Business Cycle, the as the name suggests, Access Business Cycle, you know that this fund is about identifying the opportunities between the cycles because every economy, a company, or a sector goes through a different cycle there. So just to identify exactly what works when is the purpose of or the purpose of this fund to do. We have Mr. Ashish Naik with us, who's the fund manager here, and has experience of almost 2 decades, and with Access almost 13 years. So over to you, Ashish. To explain about the NFO.
Sure. Thank you so much, Shikha, and good evening, everybody. Thank you for your interest. And I'm sure this will be a session where we can address all your queries. And I'm sure thankful for your support for all our products in the past, and hopefully for this one too. In terms of what we are trying to do in the Access Business Cycles Fund, as the name suggests, it is trying to invest into the overall business cycles opportunity that is available in the market. So, what really is a business cycle? Any repetitive sort of movement is what we call as a cycle. We see it on a daily activities where we start a day, morning, afternoon, evening, night, and again we start with the day. So, any changing sort of repetitive motion is a cycle. Businesses likewise are a continuous changing entity, and hence they also have their own cycles. The way it works is largely for a business is in terms of demand of its products or services results into pricing moving higher as well as margins. Over a period of time, supply starts catching up. Then there is a peak of pricing over a period of time. Again, because supply is higher versus demand, prices fall. At some point of time, there is another turn towards higher pricing as demand increases at lower prices. So clearly, this repetitive motion is what is a business cycle, and that creates various opportunities from an investment perspective. Businesses, larger and smaller, have are cyclical. Some are more, some are less. Similarly, economy itself is made up of various businesses and individuals, and that also has its own cycle. So there is the theory of building portfolios with the help of business of economic cycle. Uh, Typical business cycle fund would generally move in terms of investing with alignment to the economic cycle. So if the economy is expanding, they will try to add certain sectors like capital goods, banking, financials, even commodities. And as the economy sort of peaks out, there will be some more investments towards consumer-oriented luxury goods, discretionary goods, because that's where spending power is the highest. And as the economy starts to slow down, these funds try to invest into defensive sort of sectors such as FMCG, pharma, telecom, utilities. So clearly, there is a alignment to the overall economic cycle in terms of which sectors to invest in. There are two issues here. One, such sort of investments can potentially result into a few sectors being slightly preferred by the market and hence becoming a crowded trade, which means it's difficult to make returns in such a scenario. Secondly, in a market or in an economy like India, there are various sectors that are still not yet fully developed, and hence their sector cycles do not necessarily work with the economy. So it's also important to look at individual sectors and try to buy those at the right point of time as well as sell them at the right point of time. And hence, that's what Axis Business Cycle Fund will also try to do. In addition to looking at the overall economy, we will also try to look at a few sectors which can do potentially well in the economy at that point of time. So as the next slide would show, we have done a basic study of how sectors move, and this is just a overall market and various sectors in it. It's a very involved slide, but if you just look at the period between FY14, fiscal year 14 to fiscal year 17, 18, a lot of sectors moved up, but they were largely focused into consumer durables, autos, IT. So we could see a tilt towards consumption, while sectors such as real estate, utilities, infrastructure, power were actually underperforming. The same thing if you look at the market when it moved up into fiscal year 21, 22, and 23, there was a tilt towards real estate, metals, as well as power, while the underperformers were consumer durables, FMCG, pharma. So clearly, there is a diversion on which sectors do well with the market. And that clearly shows that it's important to know which sectors are doing better rather than only looking at the overall economy itself. And hence, we are focusing on that as well. As the next slide would show, there are a few areas that we are trying to look into of where and how we can find opportunities of individual sectors doing well. And we have tried to focus our thought process into four key focus areas in terms of investment opportunity. We are calling as the Made in India theme, as well as there are a lot of sectors that have been in India in terms of auto ancillaries, chemicals that have been there in India for a long time. And now they are gaining the scale and the know how to sort of supply and become exporters for the world. And that's where we are calling it as integrating India into the global supply chain. So both of these things work in tandem. They will help each other in terms of trying to grow India as a manufacturing hub. So that's going to be one of the key focus areas. These two areas are going to be key focus areas for us to look at for new sector up cycles uh, in new as well as existing sectors. In addition to that, as we know, any economy cannot grow its manufacturing base without actually growing its infrastructure base. So clearly, that is where the third focus area comes into play, which is about increasing infrastructure. We need more port capacity, roads, railways, as well as many individual sectors such as water sanitation, urban development, metros, for the high level of urbanization that we are seeing. And we can see it around us. Many of you would be staying not just in the metros, but tier one, tier two, tier three cities in India. And we are seeing the kind of growth in terms of urban development that the government is doing. The whole smart city project, etc., also are part of it. And the fourth and slightly more longer term theme is the climate change. Here, we are not just talking about decarbonization, which is a 2070 goal of being carbon neutral, but we are also looking at what all things need to be done from today to reach there. It starts from renewables. Yes, we need to have solar, wind, as well as even green hydrogen capacities in the future. But it is also important to have energy efficiency, which means just look around us in terms of offices having more sort of motion censored lights, which kind of switch off when a person is not there for a long time. So clearly, these kind of things really bring in a lot of energy efficiency rather than putting new power capacities all the time. In addition to that, we know that in automobiles, we have seen emission reduction as being a very important thing that the government has been pushing for the last few years. But even that has to be done in buildings as well as industries where there is a lot of pollution that is caused by these sectors. So clearly, this brings in new areas, products, services, and themes and industries that can be investable in the future from a not just a 2, 3, but a 5, 10, and 15 years perspective. So these are the key focus areas that we are looking at in terms of investment. Another thing that is also important to note is in the last 10 years, we've not seen a big capex cycle in India, which means private companies have not put up new capacities in sectors like steel, cement, autos. A large lot of these capacities, like in power, have come in with existing capacities which were not functioning because of being defunct in terms of NPAs, etc. So now most of these industries are reaching a very high level of utilization, and in the next decade, we'll see a big private capex cycle from India. That's another cyclical opportunity that we are seeing from this fund's perspective. Just moving to the next slide, in terms of how business cycle investing is going to be done in this fund. There's going to be a three-step approach. One is to actually look at forward-looking investing, which means we'll try to buy sectors from a 2 to 3 year medium-term growth triggers perspective, which means there should be a high level of growth in terms of earnings, sales from a 2 to 3 year perspective, where we can potentially see earnings upgrade on the street as well as valuation re-rating. So these sectors are identified early, then we try to hold them for a slightly longer period in terms of higher conviction, in terms of trying to build, let's say, for example, if the sector is 10% in the benchmark, we'll try to go slightly higher, at maybe up to 20% in this sector, and have not just one or two, but maybe three, four, or five companies in this sector, because we don't know exactly who's going to be the winner at the start. Over a period of time, move towards the winners and exit from the losers. And also not just look at one industry or sector, for example, infrastructure or construction, look at various industries so that we are diversified at the same time while we are focusing or being taking aggressive stance on these sectors. The third step here is to also have a sell discipline, which means when we have a buy, a hold, we need to also look at when we are selling it. The selling discipline here is when actually the sector starts becoming a steady state growth, which means the high growth phase is over and there is a steady state of growth. At that point of time, we will try to look at another sector, and hence it is going to be a sector rotation theme where we are buying a sector for 2 3 years perspective of growth and then selling and moving another side. Next slide, please. So, just a summary here of how this fund will be different from a lot of business cycle funds that are there in the industry. Most of them largely look at and talk about investing with the economic cycle, which means if the economy is expanding, buy a few sectors. If the economy is slowing down, buy defense. Here we are saying that there are sector cycles which are also equally strong or maybe even stronger in terms of growth on their own and hence need to be also focused on. Once we have identified the sectors that we need to invest in, that's a top-down approach of investing. We will then look at the stocks in these individual sectors, which means it will be a bottom-up approach of investing, of which stocks are going to perform in those sectors. And hence, it's a hybrid approach of overall investing in this fund. Next slide, please. So here's just a summary. As we said, it's a hybrid approach, an aggressive stance of overweight and underweight. In terms of market cap, it's not going to be any particular market cap that we are choosing in terms of large, mid, or small, but we will try to keep about 50% in large caps at this point of time. In terms of themes, it will be across various industries, not focused on any particular industry or sector. In terms of stocks, it will also focus on the 350 odd stock universe that Axis has in terms of its stock universe of investable stocks. One key differential versus our other funds will be this fund will also focus on cyclical and commodity sectors, which are generally lower across our funds, given that we focus on high quality investing as a fund house. So just I think the last slide here before I give the floor back to Shikha for any questions from your side. This is a thematic fund. So 80% of this fund will be into cyclical or what we call as counter-cyclical themes, which can benefit in a down cycle such as IT. And only 20% of the fund will go into defensives. To that extent, it is slightly more concentrated portfolio versus a diversified flexi cap fund. In terms of the benchmark for this, as mandated by SEBI, it is Nifty 500 index. So I think we can stop here. Maybe Shikha, we can take any questions on this or the market or any other funds that the investors have.
Thank you so much, Ashish. You well covered very well about the fund. A lot of questions. I'll start very specific to the funds well. What are the sectors you're looking for in this fund? Like even at this point and going forward, how do you see stock selections or sector selections in this fund to work out?
Absolutely. So yes, given that this is a cyclical fund, banking financials will be an important part of this fund, but it's not going to be the most overweight. It will be an important portion, and hence it will have its representation. The other sectors that we will look at will be maybe capital goods. As we said, a huge amount of capex cycle industrials can benefit from that, and hence that will be another sector to look at. There are a lot of sectors, smaller ones as well as larger, that are benefiting from the government policies such as PLI. So hence there will be representation from chemicals, auto ancillaries, even slightly old legacy sectors like textiles, or maybe even looking at special sectors like defense, etc. On the other side, there will be some bit of balancing to that in terms of IT as a counterbalance to ensure that there is some sort of downside protection. And finally, the remaining portion will be much lesser will be into defensive such as FMCG, pharma, telecom.
Thank you, Ashish. Ashish, there are a lot of questions regarding the positioning of the fund and how it is
Mhm.
different from other access offering. Also, how it is different from the contra fund or the flexi cap fund. Could you throw us
Mhm.
some light on the positioning of the fund?
Sure. So in terms of positioning versus the other business cycle fund, as we said, this fund will not just focus on the economic cycle, while that will have some representation. So for example, sectors like banking, financials, or maybe even commodities are decided based on how the overall economy is doing. If the global economy is doing well, and let's say economies like China are doing well, commodities get a much higher weight. On the other side, if the domestic economy is sort of in expansionary mode, banking financials get an overweight in such funds. But on the other side, there are many sectors which are being doing well on their own upcycle, and hence they will also be getting a decent representation in this fund, which maybe other business cycle funds are not doing to that extent. That will be the one differentiator that we will have. Clearly, that will position and create a different sort of portfolio versus other peer group. In terms of differentiating this fund versus, let's say, a contra fund generally looks at buying sectors that nobody else is looking at, and probably has hence sort of derated a lot. Here we are not trying to start with that as a starting point in terms of sectors which have sort of fallen or nobody's investing. We will try to look at sectors which can potentially do well from a 2 to 3 year perspective. Some of them might be invested by a few other investors, but we will try to be early into them over a period of time so that we can get the whole benefit of the higher up cycle. So versus a contra fund, here it's not necessarily looking at just the sectors that are sort of fallen. Here's we are looking for sectors which probably have not even grown in the past and now are growing at a higher rate. So to that extent, that clearly differentiates this sort of strategy. The third is on the flexi cap fund. Yes, flexi cap fund, as we mentioned, is much more diversified in nature. It will have a decent amount of representation across defensives as well as cyclical opportunities in the market. To that extent, this fund will be having less representation from defensives, which will be up to only 20% of the fund, and maybe at some point of time even less than that. And hence, in terms of concentration, this fund will be much more focused on cyclical opportunities as a fund house, as well as specifically for the Axis Business Cycle Fund. We are trying to go slightly more aggressive in terms of our weights in specific sectors, which can again bring a big higher differentiation versus a flexi cap fund, which also takes opportunities in various sectors, but the overweight might not be so high compared to. So, for example, a flexi cap fund may have 5% overweight to a sector when it is positive. Here, it might go up to 10%. So that those kind of things will be making a higher difference.
Thank you, Ashish. One very interesting questions which have come up that the business cycles are usually activated in 2 to 3 years time.
Mhm.
So how do you plan to generate returns in this fund when the cycle turn around is quite longer?
Absolutely. So that is really why we are looking at not just one sector or industry. We will try to look at different industries so that as the business cycles in one particular industry starts turning, we are looking at another industry or sector which can do well from a 2 to 3 year perspective. The idea will be always to sort of start rotating or shifting from one sector that has done well in the past and is probably now reaching a steady state or maybe even a degrowth stage, and hence looking at something else which can grow faster. So to that extent, there will be a shift that will happen. While we are saying that we will try to find such opportunities, if we find that such opportunities are not really there, we will then look at and assume that there is a down cycle which is much stronger, and hence look at more counter cyclical plays like IT or, as I said, even defensives to some extent.
So Ashish, do you recommend this fund for the lump sum or for SIP, or what kind of investor should look for it?
So, as we are saying, this fund will be slightly riskier in terms of its risk return profile versus, let's say, a flexi cap fund. And hence, the holding period for this fund should be somewhere around 4 to 5 years. And to that extent, this is also meant for an investor who is slightly more market savvy, who understands that there is more cyclicality, which this fund will try to take. And hence, the return profile will be accordingly higher at some points of time, and equally also volatile at some points of time. On the other side, in terms of investing, as we are saying, it's a slightly longer period of horizon. One should look at being in any case from an equity perspective, SIP is something that we generally look at as a consistent sort of investment, where in volatility one can benefit from let's say a bigger fall by getting slightly higher positions in those funds, and at the high and being slightly more disciplined when the markets are slightly higher. So to that extent, it sort of helps in terms of beating volatility if one does steady sort of investments into equity investments, and that also applies for this kind of.
So Ashish, this being a thematic fund, does it hold advantage over the other funds, which are like other core or plain vanilla fund?
I guess that's versus a diversified fund is what we are asking. Yes, so yes, this fund will have some an advantage in terms of trying to capture opportunities in cyclical sectors, cyclical opportunities that the economy is giving us currently. We know that largely, as you know, if you look at our economy, the first decade of this century was about B2B investments, infrastructure, power, telecom were the sectors doing well. The last decade was largely about consumption. We could see various consumption and consumption related sectors like consumer finance did quite well. But investments and overall B2B was not a big portion of the overall economic growth. We are now seeing a phase where at a $3 trillion plus economy, for us to grow at 6 to 7%, it will not be just consumption that drives the economy. Investments will also become equally important. And hence the government's focus on capex as well as infrastructure growth and manufacturing is important. So this fund is, in to that extent, also looking at these opportunities in a specific manner, and hence it does make sense from an investor perspective to look at this fund as one of the sort of medium to long term theme that will play out in the Indian economy.
Ashish, looking at the current scenario where the global market are going to slow down, the commodities are being very volatile and at peak. Why do you recommend this fund at this point in time?
Sure. So yes, we do understand that global economy will, as at this point of time, because of high interest rates, uh, go into a slowdown for some time. And we have had a very high base of recovery from COVID across various parts of the world, and maybe some parts of the world are still not completely recovered from COVID. To that extent, yes, there will be lower growth. There will be a period where maybe there is in the developed countries what we call as a shallow recession, and hence some sectors like commodities might not be completely favored by the market at this point of time. And hence, we will obviously take that into consideration when we are investing this fund. But as we discussed over the uh, uh, proceedings in this call, that there are various sectors in India that are actually independently growing of these sort of opportunities, where they are not just growing because of Indian domestic story of private capex, infrastructure growth, or manufacturing, which is import substitution, but also growing because they are into various sectors that are in themes like China plus one, where there are industries where China was a huge sort of supplier, and global companies, global MNCs are looking for other sort of industries and businesses who can provide them in various other countries, which is called as a China plus strategy, China plus one strategy. Those sort of things can work. Another example is if you look at, let's say, a domestic auto ancillary or various such companies who are sort of a subsidiary of a MNC company. Over a period of time, they have been just supplying in India, but now they have got the know-how and the sort of cost advantage that they are able to supply to their parent. These sort of things are kind of independent of how the overall global economy is doing, because at the end of the day, it is a slightly lower growth that we are seeing from the developed world, and to that extent, there is still an underlying demand that can be still catered from various parts of the world, and hence we can potentially replace. So we feel that yes, global economy when it grows faster, exports story will become even stronger. But at this point of time, also there are many companies who are still able to show decent growth in exports. And at the same time, as I said, the larger portion is looking at cyclical opportunities in India that are being driven by the economic cycle in.
Ashish, there's one question on what will be the tax applicability of this fund, and also they have linked it with whether you will invest it in the what kind of sectors you will invest in, whether you take exposure in commodities, and will that impact the taxation of the fund?
No, so we will not directly invest into commodities. This is a pure equity fund that we are looking at. In terms of taxability, it will work as a equity taxation, equity fund taxation, and hence that it's not very different from any of our pure domestic funds that we
There's questions on what are the sectors or the stocks you will pick up. Also, how you will compare it with the benchmark Nifty.
have. So here the benchmark will be Nifty 500. But as I mentioned, the sectors will be much more cyclical oriented. There will be sectors that can potentially do well because of the economy, such as banking, financials. We will probably, as we discussed, not look so much at commodities at this point of time, but there will be also sectors that are doing well from the economy in terms of capex cycle, in terms of infrastructure cycle, and manufacturing that can grow. To counterbalance, we will look at IT as well as some defensives to sort of have a risk balanced risk approach. What we will probably not have big here, as I said, is specifically defensive sectors versus, let's say, a diversified fund. Unfortunately, we cannot talk about stocks, but a lot of the opportunities in these sectors will be taken towards not just the established large caps, but also look at companies that can potentially grow faster in the mid and small caps.
Nish, how do you see 2023 to turn up, and what are the investments you recommend people to do over this year?
Mhm. So yes, it's going to be a volatile year. Not probably as much as what we have seen in 2022 if we don't have those sort of events. What actually transpired in the last calendar year was largely because of the happenings in the geopolitical crisis. So barring that, things in the global economy as well as domestic economy look towards stabilization of inflation and hence interest rates peaking out at various parts of the world at different points of time. Maybe they peak out earlier in India and slightly later in the developed world because of their inflation being slightly more service oriented, wage inflation, etc., which is slightly more stickier, and unemployment still hasn't risen there. So there is resilience in economies like US, and hence inflation there is slightly longer, and hence interest rates over there might not fall immediately. So to that extent, in terms of returns from a market perspective, one needs to be slightly more careful in terms of taking exposure to companies that have re-rated or whose valuations have gone up substantially in the last 2 to 3 years, largely because of COVID-led growth. Overall, if you look at the Nifty 50, valuations are, I would say, reasonable, given that they are around the 10-year average PE levels, and to that extent, not very high valuations. Having said that, India as a market has done quite well in the last 3 years versus various parts of the world, and hence the ask rate is also high in terms of earnings growth from us. On the other side, mid and small cap, as I said, there are many companies there who have re-rated much more in terms of valuations, and one needs to be careful on what sort of exposure one takes. So all in all, I think it's from a market perspective, equity market perspective, it's a stock pickers market. Yes, there will be opportunities from a near term in terms of debt market, where potentially rate cuts and let's say fall in yield can give some opportunities for higher duration plays. But I would rather stick to my bets on the equity market from a medium to long term perspective, given that we are seeing a good runway of growth from the economic perspective.
Actually, there's a question from an investor who said that he has invested in Access Growth Opportunity Fund and Access Nasdaq Fund, and the
Mhm.
performance has not been good. So, any reason why it has happened, and what are the actions you are taking in this fund?
Sure. So before we go, because obviously this has to talk about not just the growth opportunities, but generally a thought philosophy that we have or investment philosophy that we have as Axis Mutual Fund across our funds in general. So as we know, Axis as a fund house believes in what we call as growth and quality strategy. We try to identify companies which are able to have quality growth, which means moderate to high level of growth on a sustainable basis over a longer period of time with higher ROE and cash flows. Such businesses generally are leaders or become leaders in their sectors over a period of time with the right kind of management and business model, as well as the ownership in terms of promoters. So, as we've seen, such businesses do get a certain premium at various points in the market. And what we look for here is a sustainable growth from a longer period of time in terms of their earnings, etc. So we try to partner with these businesses and become owners sort of in these businesses, and hence grow with them as they grow. So we have done that across all our funds generally as a philosophy, and we've always been sticking to this kind of philosophy. There are various other investment styles, as you would know, in the market, which also do well at various points in time. especially stocks which are generally what we call as largely cyclical in nature, that have ROEs that can move from very low levels to very high levels over a period of time, and hence their valuations are also much more volatile. At points of time when they are volatile in terms of an up move, such strategies can actually do much better versus, let's say, a quality style, because the returns there can be as high as 60-70% in a year. But at the same time, when things turn, the fall also can be equally higher, maybe 30, 40, 50%. So to that extent, we do not prefer to expose our clients in terms of exposure to such strategies or stocks as a general philosophy. As we have said, cyclical opportunities are much more volatile and hence not really preferable for all kinds of investors in mutual that's been something that has worked for us many years. There have been years when they have not, especially when interest rates have moved up, like the last 18 to 12 to 18 months, at substantially. Such strategies are actually do not work. The reason is when interest rates are going higher, the message that the central bankers across the world are giving is that they want to curb growth to sort of bring inflation down. When the growth is being brought down even to the level of recession, it's actually going to hurt companies which are getting higher valuation for growth in terms of both quality as well as high growth strategies and high PE stocks. To that extent, there have been a correction across the board, and it's not just in India. An example here is, for example, in 2022, India was a market which was probably flattish to 5% higher. US markets, if you compare, S&P 500 was down 15%, but the high growth sector there, such as the Nasdaq, was actually down more than 40% at one point of time. Clearly, that shows that high PE stocks were hurt much more in such an environment. And because of our quality philosophy, that has also been one of the reasons that we have not performed. On the other side, if you look at the Indian markets, the sectors that have done well or the investment styles that have done well, which has resulted into slightly higher underperformance for us, has been, as I said, cyclical or value strategies, as well as if you look at mid and small cap companies sector, there have been many companies or sectors which have actually grown much faster, and to that extent, you have hurt us slightly more. And if we now come to specifically on the Access Growth Opportunities Fund, as we know, a part of this portion, fund also invests into overseas investment, and hence there has been a mix of underperformance across not just the domestic, but the overall high tech or high sort of alpha opportunities or high P opportunities that the fund invests into on the global side has also taken a sort of beating in the last 12 to 18 months. Having said that, we are still confident that most of the companies that we have in not just our domestic but even on our overseas portfolio are companies that have been consistently performing well, and hence over a period of time, once growth slows down and market starts to focus on companies that can consistently do well, that these sort of investments should come back. Another thing to look out for in terms of performance would be interest rates sort of coming down, which sort of gives an impetus to growth across the world.
Well covered, Ashish. I think it answers most of the questions. There are a lot of questions on that, and I
Mhm.
think it covers most of them. So one specific question when the people want to know that the business cycle fund, will it perform across the cycle, or will it perform only in peak or expansion time?
So as we said, we are not only trying to invest with in line with the economic expansion theme or how the economy is doing. We will try to find sectors that can potentially do well regardless of how the economy is. Having said that, the better or the higher growth in the overall economy and markets is always higher when the overall economy is doing well, because then there are many more sectors that can grow much faster. So to that extent, across any equity fund, we will generally find some sort of a correlation with the market cycle and economy. But that does not mean that as our business cycle, we will also try to find opportunities when the overall economy is not expanding as much, so that we are able to find slightly better or much, better growth versus how the economy.
So Ashish, along with this, there's one more question which got added to it. Is like,
Mhm.
among all the business cycle funds in the industry, why
Mhm.
one shouldn't consider investing in excess business cycle fund?
So yes, as we said, if there are most of the funds generally typically look at only buying across economic cycles. If we keep that in line and also look at slightly more sectoral opportunities, there can be much higher growth that can potentially be garnered over a period of time. And hence, looking at not just the economic, but looking at sector cycles and building a portfolio that can sort of get a boost from trying to find individual sector opportunities will be important. And more importantly, it is not only about finding a sector and staying with it. As we said, it's a buy, hold, and sell strategy. Hence, to sort of look at rotating and trying to find sectors that can consistently do well over various points of time can add much more value. And that's what we will try to do in the Access Business Cycle Fund.
Actually, just one question on why one should consider investing in this fund and how much should they consider investing?
I think we just answered the first part about how much it will depend on the client's risk appetite. Clearly, if the client needs to also understand that this is a slightly more high growth strategy, we are trying to take a slightly higher active risk by not being very well diversified compared to a pure flexi cap fund. And hence, the returns also should, over a period of time, as we said, 4 to 5 years is when the sector cycle generally plays out across the various sectors and the economy. And hence, that over that period of time, this fund should ideally have higher active returns versus a flexi cap fund. On the other side, what one also needs to understand is there are many sector funds in the market which have their own cycle. And many a times we see that sectors such as pharma, infrastructure have their own funds, which do well for some maybe about 2, 3 years and then don't after a period of time. What this fund will do is actually have this exactly, sort of mitigated by having various fund sector cycles into it, where it participates in the upcycle and exits when the cycle is actually stabilized or on in a downside.
Just, there's a one question on different fund. I'll just take it that I've invested in Triple Advantage funds and want to know what is happening in the fund, what's the strategy and the performance.
Sure. As a fund, a triple advantage fund, as we know, we have tried to position it as an aggressive hybrid fund plus fund. What it means is we are trying to do similar equity levels as any aggressive hybrid fund would do, which is about 65 to 80% in equities. At any most part of time, we are between 70 to 75% in equities, but the remaining portion, which the aggressive hybrid fund would generally put into debt, here we distribute it into debt as well as gold, which is basically commodities. To that extent, there is a sort of protection that the commodity part, which is a third asset class, gold, provides us as a fund. There is equity, debt, as well as gold. And clearly, because gold and these three asset classes don't move in the same direction across various market events or over a period of time, there is what we call as the benefit of diversification. Uh, to that extent, this fund we aim will be able to sort of generate higher returns compared to an aggressive hybrid fund over, let's say, 2 to 3 years or higher period of time. Having said that, the equity portion of this fund, especially in the last 12 to 18 months, has not really performed as well versus, let's say, the benchmark and some of the peers, and hence the performance looks slightly weaker. And the reason for that is again largely similar to what we have discussed as the Axis being a quality focused fund house and that investment style not really playing out in this time.
Um, it's a question about the business cycle fund, Ashish. That what is the risk of the fund, and will you recommend it for the senior citizen or for a shorter period of investments?
So as I said, 4 to 5 years would be the ideal time horizon because in a slightly shorter period of time, there might be slightly higher volatility, which can hurt the investors potentially. From a senior citizen perspective, I think what one needs to understand is how sort of their portfolio and goals in terms of investment are positioned. As long as their basic goals in terms of near term, short term to medium term are taken care of, one can take slightly higher, riskier strategies in their overall portfolio. But it's important from taking advice from the right kind of investment advisor who has the holistic idea of their business, of their overall investment portfolio. and sort of give them advice on how to go about it. In general, thematic funds should not be a huge portion of investors' portfolio, given that they are slightly more riskier than a diversified funds.
There's one question on Access Blue Chip Fund. It's asking about is it the right time to invest in that fund or to hold your investment in that fund because the
Mhm.
fund is not showing any growth since 2 years.
Absolutely. So again, I on the performance side, it has not been most of our equity funds have not really performed well in the last 12 to 18 months, given that the style hasn't worked. We do believe that as the interest cycle reverses and we start seeing growth being more focused towards the leaders, large caps across various sectors, there will be a tilt towards quality focused investing over a period of time, and hence, from that perspective, I am confident that these funds uh, uh, will potentially see better days than in the past. We obviously can't put a timeline to such thing because we don't know how market movements will happen and flows will work. Having said that, as I said, from a overall valuation perspective, large caps look more reasonable, and hence, from that perspective, blue chip as a fund should see better days.
So coming back to business cycle fund, this question on what proportion will you hold in the large, mid, and small cap, and will you invest in small and mid cap as well?
Yes, so we do plan to invest in mid and small caps, but at any point of time, we will try to keep, for the time being, about 50% of the fund at least into large caps and the remaining into mid and small. So as probably slightly higher tilt towards large cap at this point of time. But as we try to find newer sectors where there are relatively smaller businesses, mid and small cap proportion can grow higher.
आशीष एक क्वेश्चन और है वो जो है कि क्या क्राइटेरिया रहेगा आपका इसमें स्टॉक सिलेक्शन का सेक्टर सिलेक्शन तो डिफाइंड है बट स्टॉक सिलेक्शन का कैसे रहेगा?
सो सेक्टर स्टॉक सिलेक्शन ये बहुत अच्छा क्वेश्चन है एक्चुअली। अगर हम स्टॉक सिलेक्शन की बात करें तो इस फंड के लिए हम ये देखेंगे कि जिस सेक्टर को हम चूज कर रहे हैं, क्या यहाँ पर अलग अलग अपॉर्चुनिटीज है। जैसे कि अगर मैं एक एग्जांपल दूं ऑटो इंडस्ट्री का, तो ऑटो इंडस्ट्री में आपको दिखेगा कि जो बड़ी कंपनियां होती हैं जिनको हम ओईएम कहते हैं, असेंबली कंपनी जो एक्चुअली प्रोडक्ट बनाते हैं, और फिर कंपोनेंट कंपनीज होते हैं जो उनको सप्लाई करते हैं। सो ये जो कंपोनेंट कंपनीज है, उनमें भी काफ़ी बार अपॉर्च्युनिटीज़ अच्छी होती है साइक्लिकली अच्छी ग्रोथ की। तो अगर समझिए ऑटो सेक्टर में हमें इन्वेस्ट करना है एज़ एन एग्ज़ाम्पल, तो हम शायद 2 या 3 स्टॉक्स जो ओईएम्स है, जो अलग-अलग टाइप के ओईएम्स है, 4 व्हीलर, 2 व्हीलर, उनमें से एक चूज़ करेंगे। और फिर अगर हमें लगता है कि एंसिलरीज़ में भी अपॉर्च्युनिटीज़ है, तो 1 या 2 स्टॉक वहाँ से भी चूज़ करेंगे। इससे हमें एक ब्लेंड मिल जाएगा कि हम पूरे ऑटो सप्लाई चेन को खेल सकें। तो इस तरह से अगर हम किसी भी सेक्टर को एनालाइज़ करें, तो अलग-अलग तरह की कंपनियाँ मिलती है, जो कि पोटेंशियली अच्छा कर सकती है। तो जिस कंपनी में हमें लगता है कि अगर 2 या 3 जो एंड ऑफ द सप्लाई चेन में जो अच्छी कंपनियाँ हैं उनको, और जो एज़ वी से इन टर्म्स ऑफ सप्लायर्स है, उनमें अगर कोई अच्छा कर रहा है तो उनको भी हम लेंगे। सो इस तरह से एक बैलेंस्ड अप्रोच होगा सेक्टर में कंपनियाँ चूज़। और इनमें धीरे-धीरे जैसे मैंने कहा कि जो इन विनर्स होंगे ओवर 2-3 इयर्स, उन पे हमारा शिफ्ट ज़्यादा होगा। जो रिलेटिवली कम ग्रो कर रहे हैं फॉर वेरियस रीज़न्स, उनसे हम एग्ज़िट करेंगे।
So, आशीष जैसे भी हम फ्लेक्सी कैप देख रहे हैं वो थोड़ा अंडर परफॉर्म कर रहा है, तो आप
हुँ, हुँ।
इस फंड को उस लाइन में कैसे देखते हैं? विल दिस फंड परफॉर्म?
जी, जी हाँ। सो जैसे हमने कहा कि फ्लेक्सी कैप या फिर जो एग्ज़ाम्पल हमने ग्रोथ अपॉर्च्युनिटीज़ या फिर ब्लू चिप का दिया कि ओवरऑल ग्रो क्वालिटी स्ट्रैटेजी जो है वो इतनी अच्छी काम नहीं की है पिछले 1 या डेढ़ साल में, जिसकी वज़ह से ये रिटर्न्स हमें अच्छे नहीं दिख रहे हैं। जैसे हमने कहा कि हायर इंटरेस्ट रेट से वैल्यूएशंस गिरे हैं, और हायर वैल्यूएशन कंपनीज़ के वैल्यूएशन में थोड़ी ज़्यादा गिरावट आई है। जैसे इंटरेस्ट रेट्स यहाँ से इम्प्रूव या फिर गिरेंगे, तो वैल्यूएशंस धीरे-धीरे इम्प्रूव हो सकते हैं क्योंकि ग्रोथ प्रोजेक्शंस बढ़ने लगेंगे ओवरऑल इकोनॉमी के। दूसरी तरफ अगर हम देखें तो ये भी इम्पोर्टेंट है कि मार्केट में क्या चला है, उस तरह के स्टॉक्स जो है वो हमारे फंड्स में ज़्यादा रहते नहीं हैं। जैसे कि मिड कैप, स्मॉल कैप का प्रोपोर्शन काफ़ी ज़्यादा रहे, या फिर वैल्यू जैसे स्टाइल्स या मोमेंटम, ये काफी सारी चीज जो स्ट्रैटेजीज है, ये पिछले 1 या 1.5 साल में ज्यादा चली है। तो जो हमारे पास ज्यादा ना होने के कारण वर्सेस बेंचमार्क या हमारे जो कंपटीशन है, हमारे फंड्स रिलेटिवली कम परफॉर्मर लग रहे हैं। बट अगर हम इन कंपनियों को एक्चुअल रिटर्न या अर्निंग्स प्रोफाइल देखें कि किस तरह से इनकी प्रॉफिट ग्रो हो रही है, काफी बार हमें ये दिखेगा कि हमारे कंपनियों की प्रॉफिट जो है वो किस तरह ग्रो हो रही है, उसको हम ध्यान में रख रहे हैं। उनका प्रॉफिटेबिलिटी जो हमको आरओई या फिर जो उनकी कैश फ्लो है, ये चीजें जो है वो इंटैक्ट होने के कारण हमें थोड़ा कॉन्फिडेंस है कि धीरे धीरे इनके वैल्यूएशंस भी इंप्रूव हो सकते हैं। और जैसे आपने कहा कि इस फंड के अगर फ्लेक्सी कैप का रिटर्न अच्छा नहीं है तो बिजनेस साइकिल का फंड रिटर्न कैसे अच्छा होगा? मेरे हिसाब से ये थोड़े अनरिलेटेड है, क्योंकि हमें लगता है कि जो बिजनेस साइकिल फंड का पोर्टफोलियो होगा वो काफी अलग होगा हमारे किसी भी फंड पोर्टफोलियो से। तकरीबन 50% से ज्यादा मैचिंग हमारे किसी दूसरे फंड से नहीं होनी चाहिए। इसीलिए हमें लगता है कि ये फंड थोड़ा अलग तरह से बिल्ड होगा। इसके फंडामेंटल्स में सिर्फ क्वालिटी कंपनीज ही नहीं होंगे, जैसे हमने कहा यहाँ पे कमोडिटीज साइक्लिकल कंपनीज ज्यादा होंगे, और वो अपॉर्चुनिटीज भी हम ध्यान में रखेंगे। हालांकि कमोडिटीज इज नॉट द स्टार्टिंग पॉइंट, बट कमोडिटी कंपनियां भी इसमें आ सकती है। दूसरी बात यह है कि काफी सारे हमारे जो फंड्स हैं वो ज्यादातर स्टेबल बिजनेसेस जो कि काफी बार कंजम्पशन ओरिएंटेड होते हैं, उनका प्रोपोर्शन रिलेटिवली ज्यादा रहता है। बट इस फंड में बिकॉज हम इंफ्रास्ट्रक्चर मैन्युफैक्चरिंग या जैसे सेक्टर्स की बात कर रहे हैं, जो ज्यादातर बी टू बी जो हम कहते हैं बिजनेस टू बिजनेस के तरह के फंड्स होंगे, और इसीलिए इनके जो बिकॉज ये ज्यादा साइक्लिकल होते हैं, इसलिए इस फंड की जो बनावट है वो काफी अलग दिखेगी हमारे दूसरे फंड से।
तो क्या इस फंड में आप ग्लोबल मार्केट में भी इन्वेस्ट करेंगे?
नहीं, सो हम ये प्योर डोमेस्टिक स्ट्रैटेजी की तरह रन करने की कोशिश करेंगे।
बट फिर भी क्या ग्लोबल मार्केट का इम्पैक्ट इस फंड के ऊपर आएगा, लाइक वॉर विच हैपेंड इन रशिया,
हम्म।
और जो भी अभी ग्लोबल सिनेरियो है उसका इम्पैक्ट इस फंड पे कितना रहेगा?
सो इसे दो तरह से देखना चाहिए कि अगर कोई बड़ा इवेंट नहीं होता है, जैसे कि वॉर या फिर ऐसी चीज जैसे लास्ट ईयर हुआ था, तो उस हिसाब से इतना ज्यादा इम्पैक्ट नहीं होना चाहिए, क्योंकि हम इस फंड को ज्यादातर डोमेस्टिक साइक्लिकल अपॉर्चुनिटीज की तरफ टिल्ट करेंगे। कमोडिटीज ऑब्वियसली इस वक्त शायद इतने ज्यादा अच्छे ना परफॉर्म करे, तो हम उनको थोड़ा इस वक्त अवॉइड करेंगे। तो उस हिसाब से देखा जाए तो बिजनेस एज यूजुअल जिसे हम कहते हैं सिनेरियो, जहां पर कोई बड़ी इवेंट नहीं हो रही है ग्लोबली, तो इस फंड में इम्पैक्ट नहीं आना चाहिए। हालांकि कोई अगर इवेंट होता भी है अभी, विच कुड अगर वॉर नहीं होता है या फिर कोई और इवेंट हो, जो रिस्क है या चैलेंज है, इज जैसे बहुत हाई इंटरेस्ट रेट्स होने के कारण किसी इमर्जिंग मार्केट्स में कोई कंपनी या किसी कंट्री को बहुत ज्यादा डिफिकल्टी हो सकती है टू पे देयर डेट। और इस तरह के जो इवेंट्स होते हैं वो ग्लोबल स्केल पे भी इम्पैक्ट करते हैं, इक्विटी मार्केट्स को भी इम्पैक्ट करते हैं। बट बिकॉज इंडिया इज मच मोर इंसुलेटेड, कि हमारा बहुत ज्यादा एक्सपोर्ट डिपेंडेंसी नहीं है, और जनरली हमने देखा है कि फ्लोज के हिसाब से भी वाइल एफआईआईज हैव नॉट बीन देयर, बट पोर्टफोलियो फ्लोज डोमेस्टिकली अच्छे रहे हैं। तो हमें लगता है कि इतना ज्यादा इम्पैक्ट ऐसे इवेंट्स का नहीं होगा। वॉर जैसे सिनारियो में जहाँ पे सप्लाई रुक जाता है या सप्लाई कुछ हद तक इम्पैक्ट होता है, वो चीजें हमें इम्पैक्ट करती हैं, क्योंकि हमें इन्फ्लेशन या इम्पोर्ट्स की वजह से इन्फ्लेशन का इम्पैक्ट आता है। तो वो चीज अगर नहीं होती है, अगर समझिए एक्सटर्नल फैक्टर से अगर अगर हमारे मैक्रो इकोनॉमी में कोई बड़ा इम्पैक्ट नहीं आता है, तो ओवरऑल इस फंड में कोई ज्यादा इम्पैक्ट नहीं आना चाहिए। बट जब इन्फ्लेशन या ऐसा कोई हाई इंटरेस्ट रेट सिनारियो होता है, तो सारे फंड सारे मार्केट को ही इम्पैक्ट करता है। जैसे हमने देखा था फर्स्ट हाफ ऑफ लास्ट ईयर बिटवीन फेब्रुवरी टू लेट्स से जून, पूरे मार्केट में इम्पैक्ट आया था। बट जैसे जैसे लोगों ने देखा कि ये इम्पैक्ट बहुत ज्यादा लॉन्ग लास्टिंग नहीं है, धीरे धीरे मार्केट्स ने उसका करेक्शन कर दिया था। सो हमें ऐसा लगता है कि ये जो शॉर्ट टर्म इवेंट्स है उसका इम्पैक्ट हो सकता है, बट ओवर बिजनेस एज यूजुअल ऐसे कोई बहुत ज्यादा इम्पैक्ट नहीं लगता।
Ashish, will this fund have a higher portfolio turnover ratio compared to the other funds?
Yes, so very good question. Unfortunately, I should have mentioned this versus, let's say, a flexi cap fund, which is much more diversified and not taking so much of churn. This fund can have maybe slightly higher churn. We estimate about 20 to 30% should be the turnover versus flexi cap fund.
Ashish, how do you identify the change in cycle?
Mhm. Absolutely. So it is obviously not something that will happen at one point of time. We will potentially, if we are looking at various sectors at various points of time, we will start seeing slightly higher growths potentially in terms of estimates from a 2 to 3 year perspective in various sectors. Those that is going to be the thing that we are going to watch out for the higher cycles that we can identify across various sectors. But if we are talking of overall economy, there are various indicators that we can look at, all the way from economic activity to credit growth, to unemployment to interest rates, as well as capex. So there are a lot of indicators. One needs to identify those things in the right point of time for the economic cycle. But when it comes to businesses, it is important to look at fundamentals of the overall sector and how the earnings growth can pan out and where the higher growth can come to switch from one to the other.
Ashish, would you swing between the different market caps there to take advantage of this changing cycle?
Yes, we will try to take slightly higher bets towards, let's say, mid and small caps if we feel the overall economic growth is much higher and there is scope for everyone to grow much faster. And in a lower growth scenario or a slowdown, we'll probably look at having more large cap opportunities, which is generally how even the market would behave. So, not really very different from how any diversified fund would.
Ashish, on the closing remark, can you give some key points about this fund that people can take away from this call?
Absolutely. So this fund, we believe, is come at the right point of time when we look at the overall economy. We have not had a big capex cycle from private industries, which gives a big opportunity for many industries to sort of benefit from in newer investments across major industries. Government policies, including what we have seen in the budget, has been quite supportive, not just of capex, but also infrastructure and the policies that have sort of helped in terms of PLI, etc., from across various industries to sort of come up the curve. The events that have happened globally are also pushing for many global majors to look at India as a major market for from a future perspective in terms of not just supplying for India but supplying for the world, and hence there are a lot of what we call as B2B opportunities, cyclical opportunities that can potentially come up in these sectors. Hence, a business cycle fund at this point of time for makes a lot of sense for us and we are quite excited to sort of find these opportunities and invest specifically into them from a 2 to 3 year perspective. So I think that's what I would leave investors with in terms of thought process.
Thank you, Ashish, and thank you everyone for joining us today. You can visit our website or download the Access Mutual Fund app to invest in the Access Business Fund. Thank you so much for joining. Happy investing, everyone. Thank you.
Thank you, Shika. Thank you, everyone, for your time and interest.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.